Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is impairment of value. And here, I want to let you know that impairment of value we have based on IFRS and USGAAP. However, they are two very different ways. So today, our topic is specifically about the USGAAP. We also have a video about how to do this, but on the IFRS standard. And this link is in our video description. Okay. So what is impairment of value? Implicit assumption on in allocating the cost of an asset over its useful life is that there has been no significant reduction of in the anticipated total benefits or service potential of the asset. However, situations can arise that causes significant decline or impairment of those benefit or service potential. Example, building destroyed by fire, uh, remain so uh, before the asset sorry is fully depreciated. So the remaining book value of the asset is written off as a loss. Recognizing and measuring an impairment loss depends on whether the assets are to be held and used or being held for sale. Asset held and used should be written down if there has significant impairment of value. A write-down can provide important information about the future cash flow that a company can generate from using the asset. Even if this significant impairment of value has occurred, it often is difficult to measure the amount of the required write-down. That is a huge problem. So what do we have here? For assets to be held and used, that is the most common one. Different guidelines are applied to property, plant, and equipment and intangible assets with finite useful lives, or subject to depreciation, depletion, or amortization, and a different guideline for intangible assets with indefinite useful lives, or not subject to amortization. And when, according to GAAP, when to test for impairment? Only if events or changes in circumstances indicate that the book value of asset or asset group may not be recoverable. This is the first difference between US GAAP and IFRS. IFRS demands it to be done annually. If an impairment loss is recognized, the written down book values become the new cost base for future cost allocation. So it's just like we are selling our old asset and purchasing a new asset. And we have two-step process. Step one, recoverability test. We have no loss here. This step one is only to double check. Do we need an impairment test or not? So, uh, how do we do that? We compare the book value with the undiscounted sum of estimated future cash flow. So, undiscounted cash flow. So we don't bring it to present value. Okay, we have a loss. We have a book value of 10 and our undiscounted sum of estimated cash flow is 9. So, okay, we need to go to step number 2 because we had a loss. If we don't have a loss, we stop there. Nothing is done. Our book value is 10. Our undiscounted sum of estimated future cash flow is 12. No loss, nothing is done. Okay, we have a loss. Let's go to step number 2. If impaired, from step 1, record an impairment loss for the amount by which the asset's fair value is less than book value. If not impaired, no impairment loss is recorded. So step 2, we record the loss. And how do we do that? Fair value usually is the how much money I will get, will I get, sorry, if we sell this asset or based on discounted cash flow. And why do we have a loss here? Because if we have a loss when we work with undiscounted cash flow, for sure we will have a loss with discounted cash flow because discounted cash flow is always lower than undiscounted because they are discounted. Okay? And let's go to our Excel file. Our Excel file here. Okay, so oh, okay, let's do it together. Scrapping Corporation, my fake company, operates several factories that manufacture medical equipment. Near the end of company's 2020 fiscal year, a changing business climate related to a competitor's innovative products indicates to manage that 106 million book value. So this is my book value. Original cost of 400 million. So original cost 400 million less accumulated depreciation of 240. Less accumulated depreciation 140. So our book value here 160. So our T accounts beginning balance factory assets 400, accumulated depreciation 240. Okay, and it may not be recoverable. So let's test it. Management is able to identify cash flow from this factor and estimate the future cash flow over remaining useful life of the factory will be 130 million. So this is our step number one. So step number one, our undiscounted cash flow, $130 million. So step number one, recoverability. Undiscounted future cash flow, 130. Book value, 150. Or let's do it better. Less book value, and here less accumulated depreciation. So less book value, 160. Oh, we have a loss, $30 million. Okay, let's record it, but we don't record the loss on step number one. Step number one, we use for only if we have a loss or not. So if we will go on or not. Oh, let's change it here, last book value. Okay, how much the fair value? The fair value of factory assets is not readily available, but is estimated to be $120,000. So $120,000. So what do we have here? Step number two, fair value less book value. Book value 160 and our impairment loss 40. Okay, let's go to our journal entry. How do we record it? If we go back here, the last one, if an impairment loss is recognized, the written down book values becomes the new cost base for future cost allocation. So come on, come here. Our ending balance of factory assets must be 120, must match with the fair value. So as I told you before, it is just like we are selling our old uh, asset and we are purchasing a new one. Under quote here, purchase. So what do we have? So journal entries. So first of all, we debit our accumulated depreciation here. So because we are under quote here purchasing a new equipment or a new factory. So we have no accumulated depreciation anymore. Loss on impairment, a debit because it is a loss. And here, the factory asset is the number to balance this journal entry. So sum Our debits, 280. Factory assets, 280. We have here our fair value as our ending balance. Okay, we are good to go. Our new asset, 120, and then we need to estimate our new useful life, our new residual value, and so on. Okay, and here, what about indefinite life? Oh, and this one we do for property, plant, and equipment and intangible asset uh, with finite life. What about indefinite life intangible assets other than goodwill? Uh, that's for impairment annually. Here is not only when we want it, it's annually. Uh, and then we can work with qualitative assessment or quantitative tests. And it's a one-step process. We don't have the two-step process. If fair value is less than book value, an impairment loss is recognized for the difference. So there is no recoverability test. There is no step number one here. We go directly to step number two. Okay, so this is the difference. And then the same, if impairment loss is recognized, the written down book value becomes the new cost for future cost allocation. And what about goodwill? Goodwill is a unique intangible asset because unlike other assets, its cost can be directly associated with any specifically identifiable right and is not separable from the company as a whole. So, level of testing is the reporting unit. Reporting unit is an operating segment of a company or a component of an operating segment for which discrete financial information is available, and segment management regularly reviews the operating results of that company. And we compare the value of the reporting unit itself with its book value. If the fair value is less than its book value, an impairment loss is indicated. So here, we don't have the first step either. And the impairment loss is the amount by which the fair value exceeds the book value. However, the recognized loss can exceed the book value of goodwill. Okay? So reversal of previous goodwill impairment loss is not allowed. And either any other impairment loss. We cannot reverse impairment loss based on USGAAP. Second difference between USGAAP and IFRS, by the way. Okay, guys, so thank you so much. Please subscribe our channel, like our Facebook page, Accounting Hub by Dr. Scarpin. Like this video. If you have questions or comments, leave it here or email me at jscarpin@gmail.com. Have a very nice day and God bless you.